Hi, it's Dave Armstrong with Monument Wealth Management, and today I want to talk about the recent market correction and all the turmoil going in the markets. The market's continuing to slide deeper into correction territory, which is defined as about a 10 or 20% drop from an all-time high. But before I dive any deeper into my thoughts, let's level set some terminology, starting with market correction. This is defined as a drop of at least 10% or more for an index off of its high, and we got here on Thursday after a pretty steep sell-off. Now, a bear market is defined as a 20% or more decline in stock prices or a stock index. Now, I know that no stats or frequencies or amount of time to recover will ever make an investor feel good about the current correction or even a bear market, but they do set some expectations to help everyone understand what we're most likely dealing with. So first, let's review some statistics surrounding a market correction. Again, by definition, this is when an index drops by over 10%, but not quite 20%, off of an all-time high. On average, we see a market correction about once a year, and they usually last 3 to 4 months. The average market loss during a market correction is somewhere around 13.3%, and the worst loss in a market correction by definition is 20%, because that's when a market correction becomes a bear market. And the smallest loss, obviously by definition, is 10%. So now let's talk about a bear market. This is by definition anytime the market drops by over 20% from its all-time high, and this usually happens on average every 3.5 years. Historically, they have lasted about 10 months with an average market loss of about 35%. Now, the worst loss during a bear market was 1931, where the bear market resulted in a 62% loss, while the smallest loss was 21%, and that was recorded in 1949. In a bear market, the average time to recover is somewhere around 22 months, so essentially 2 years. And bear markets usually happen due to some sort of fundamental reason, such as a recession or a lending bubble. You think about 2002 with the exuberant market valuations, or high interest rates can do it too. Okay, so here are some things to know about a market correction. These usually happen around once a year. They also tend to happen for no specific reason, or based on some sort of news event like we saw back in December of 2018, if you remember that, or even today. And market corrections rarely last that long. In fact, they tend to average somewhere between 3 and 4 months in length. They also take another 3 to 4 months to recover. So after a period of, let's say, 6 to 8 months from the start of a correction to the end of a correction, the stocks have generally fully recovered. Again, that's on average. Also, market corrections should really only be a matter for short-term traders and not for long-term investors. In most market corrections, there's a really sharp recovery with very little bottom building or retracing. And what that means is that recoveries tend to be swift and steep. A stock market correction is often a good time to pick up high-quality companies at an attractive valuation. See my last video where I talked about Warren Buffett. Here's what we recommend people do during market corrections. First, don't make hasty decisions. Patience and discipline and focusing on the long term rather than the short term tends to help investors more than anything else. And I know it's hard to do given the news and everything with the severity of the sell-off, but in a world of do something, never underestimate the power of do nothing as the best way to actually do something. Another thing to keep in mind is that the market's recovery will probably come sooner rather than later, unless the economic situation changes, which would shift us into a bear market. And frankly, this could. But I believe that it's actually what's causing this. What if this causes a recession? What if this really impacts corporate earnings? That's what's happening, I think. So if we do shift into a bear market, it will take some good news and some better economic conditions to spark a recovery out of a bear market. Again, if that happens, the markets will recover, and those tend to happen when the news starts to look good. And this is why we rely on our Mon-Con recession model, because the Mon-Con will never call the exact bottom of a market to start raising cash, nor will it catch the very top to deploy it back in, but it does a good enough job to keep us from making emotional decisions in a correction and provide some protection by raising cash well before the bottom. Remember March of 2009. No one on March 9th of 2009 thought it would be the best time to get back into the market. And it wasn't until way, way, way later than people who said, oh, I just want to wait until things get better, actually got back into the market. And this is why, as an investor, identifying your cash needs well in advance of conditions like now is so important. No one who raised cash in January for projects or living needs has to worry about raising cash now, and probably, hopefully won't have to for 12 to 18 months, which increases the probability that a recovery happens well in advance of their next cash raise window. We believe in our broken record of having a plan that incorporates for environments like now and in our conviction that cash is always the best hedge against volatility and market conditions like now. Most people know that famous scene from Apocalypse Now where Robert Duvall's character, Lieutenant Colonel Billy Kilgore, says, "I love the smell of napalm in the morning. It smells like victory." But it's actually his line afterwards that I think is one of the best parts of the whole scene. As mortar shells fall and explode around him on this beach, he's seen kneeling, shirtless, wearing nothing but his trousers, his dog tags, and that iconic Stetson hat. And he's talking to Martin Sheen's character, a special operations army captain named Ben Willard. And Captain Willard is seen in his full combat equipment. He's got his helmet, his weapon, his flak jacket, the whole thing. It's a total dichotomy, the older infantry officer being this cavalier guy while the younger special forces captain is hunkered down with all of his gear. And Lieutenant Kilgore pauses right after that victory line. He says this, "Someday, this war is going to end. Someday, this current sell-off is going to end. But over the short term, no one can possibly know what's next." However, like the confident Lieutenant Colonel Kilgore, I can tell you that this will come to an end, and over the long term, portfolios will recover and surpass even the most recent high. Short-term reactions are nothing more than guessing, and it's impossible to be a good guesser. So don't try to be the good guesser. Rather, be good at the guessing game, which I outlined last week in my blog. Market recoveries will come sooner than you expect, so because of that, don't try to time this market bottom. Again, recoveries tend to be sharp and quick, and people who try to time in and out of the market may miss a significant rebound. Despite all the corrections in bear markets, equities have fared the best in the long run. Remember that the S&P 500 has returned a compounded annual growth rate of close to 9%, not only over the past 10 years, but also over the past 20 years. So it pays to be a long-term investor and leave the trading to others. Call us with any questions that you have, any concerns that you have, but I hope this gives everyone an idea of how we're viewing this current market condition.